Yo, ever wonder who decides when interest rate go up or down? Spoiler, it's not the president. It's something called the Federal Reserve. But what even is that? Let's break it down on Jay Get It. The Federal Reserve, aka the Fed, is a central bank of the United States. Think of it like the boss of all the other banks. It was created in 1913 after a bunch of financial panics made everyone realize, yo, we need a system to control this chaos. Before the Fed, banks were doing the most. No stability, no backup plans, just vibes. So Congress stepped in and said, let's build something that keeps inflation, unemployment, and recessions in check. That became the Fed. When the Fed changes interest rates, it's like pulling a lever on the economy. If inflation is too high, raise rates, make borrowing more expensive, slow down spending. If the economy is in a slump, drop those rates, make loans cheaper, boost activity. So when you see a TikTok talking about student loan rates or your credit card APR going wild, that's probably the Fed behind the scenes. The Fed has a chair right now. That's Jerome Powell. He's like the face of the whole operation. But plot twist, the president can't fire him just like that. Once the chair is appointed and confirmed by the Senate, they serve a 4-year term. That means the Fed does its thing without politics messing with every little decision, which is kind of smart, right? Here's the deal. Interest rates touch everything. Your car loan, your student loans, even job opportunities. When the Fed moves, your wallet feels it, even if you don't notice it right away. So understand the Fed equals knowing how money flows into the US, and the more you know, the less likely you are to get played by the system. Alright, now you get it. The Fed, interest rate, and why it all matters. If this helped you feel smarter about money, hit that like button, subscribe for more real talk, and share this with someone who still thinks the president controls everything. Catch you next time on Jay Get It.